2 weeks ago, I was sitting across another entrepreneur in our Dubai office, a successful tech entrepreneur, and he was making 2 million a year, and he was so stressed. And it turned out he received a letter from the UK tax authorities, and they were demanding £740,000 back in taxes, penalties, and interest. But he said, "Hey Zach, I have a Dubai visa, I have a free zone company, even bought property here. How is this happening?" I see this scenario play out every single month. Smart, successful people who think that escaped high taxes by moving to Dubai, only to get slapped by devastating tax bills from their home countries. And the worst part, it is completely avoidable. There's a massive gap between that people think that makes them tax-free in Dubai and what actually protects them. And it's not just about having a visa, a company, there's a whole system you need to follow, and almost nobody talking about it. Today, I'm pulling back the curtain on everything you need to know about the UAE taxes in 2025. Not just about corporate and personal tax rate, I will cover those details, but the exact blueprint for making sure your home country can't come after you. And this complete no BS guide that I normally only share my highest paying clients. So stick around till the end because I'm going to share the 3 biggest mistakes that have cost people millions, including one critical document most people don't even know they need. Hi, I'm Zach from Emifast, and we specialize in helping entrepreneurs legally reduce their tax burden through strategic relocating to places like Dubai. If you're tired of watching your hard-earned money disappear through taxes, this might be the most important video you will watch this year. And before we dive in, smash that like button and subscribe if you want more straight talk about the global tax strategies. This video is packed with real-world examples and actionable advice that could save you a fortune. Alright, let's get into it. I'm going to break this into 5 different parts. The real deal with the UAE tax rates in 2025. The difference between having a visa and being a tax resident. How to properly structure your business and income. How to bulletproof yourself and get your home country's tax authorities. And the last one, the biggest mistakes people make that costed everything. So let's start with the basics. Everyone's talking about how the UAE introduced a 9% corporate tax rate and they're acting like tax-free party is over. But that's completely wrong. Here's the truth. If your business makes less than 3 million dirhams per year, that's about $800,000, your corporate tax rate is still zero. Nothing, none. This small business relief program is locked until at least 2026. And even if your business makes more than that, the first $102,000 is completely tax-free. Anything above is taxed at 9%. Let's put it in perspective with some numbers. Now, say your business generates 4 million dirhams in revenue, and after all expenses and salaries, your net profit is 500,000 dirhams. Now, the first 375,000 dirhams is tax-free. The remaining 125 is taxed at 9%. That's just about 11,250 dirhams of tax, about $3,000. Now compare that to the UK, where the same profit would cost you around $100,000 in taxes. Or Germany, where it could even be higher. The difference is staggering. A personal income tax, zero, no matter how much you earn. Capital gain tax, zero. Inheritance tax, zero. And this is why Dubai remains one of the best tax environments on the planet in 2025. But, and this is the crucial thing, these rates only apply if you're doing things correctly. This is where most people mess up big time. So they think having a Dubai visa automatically makes them tax-free. It doesn't, and not even close. A UAE residency visa is not the same as a tax residence. So your residency visa just allows you to live in Dubai. It has nothing to do with your tax status. You can have a golden visa, an investor visa, or a business visa, or remote work visa, it doesn't matter. None of these automatically makes you a tax-free in the eyes of your home country. What you really need is a tax residency certificate or TRC. This is the golden ticket that proves to your home country that you're officially a tax resident in the UAE. But here nobody tells you. Getting a TRC isn't automatic or guaranteed. The UAE government won't just hand it over because you had a visa. You need to demonstrate substance, providing actually of proving that your life is generally centered in Dubai. I had a British client who spent over $50,000 signing up his business and getting his visa, only to get rejected for a TRC. And why? Because he couldn't prove he actually lives in Dubai. And no lease on his name, no minimal time spent here, no utility bills, and UAE authorities saw right through it. And without a TRC, his home country continued to treat him as a tax resident, entitling them to tax his global income. So you've got your visa and you're working on becoming a legitimate tax resident. Now, how do you actually structure your business and income to maximize tax efficiency? First, you decide between mainland or free zone. There are over 45 free zones in the UAE, each with different rules and benefits. For most people, a free zone company is the best option. 100% foreign ownership, no VAT on export, and simpler compliance requirements. But there's a common misconception that free zones are always cheaper, because it's not always, and let me explain why. Free zones typically have a lower upfront cost, but as your business grows, the cost can skyrocket. Every time you add a visa, your office requirement increase, and so does your bill. Now, one of our clients initially set up a free zone company just because it got cheaper. Low initial license fee, nice to build package, but as they grew to 8 employees, they were paying almost double what a mainland setup would actually cost. And eventually, they had to scrap the free zone license, move everything to the mainland, costing them even more in switching fees and delays. If you're planning to scale, hire a team, and serve clients in the UAE, the mainland is often a better long-term solution. If you're a solo entrepreneur dealing mostly with international clients, a free zone could be perfect. Next, let's talk about how you pay yourself. So when your company qualified for zero tax, you have two ways to take money out: salary and dividends. Salary in the UAE, no personal income tax, and dividends, they are post-tax distribution, but if your company pays zero tax, your dividends are effectively tax-free too. But don't make this rookie mistake of paying yourself $1 million in salary and have no profit left. That looks suspicious. So you need to pay yourself a reasonable market rate first, and then you can take the rest out as dividend, for example. I had a client, a tech entrepreneur, making good money, who would try to pay himself $200,000 a month while he was only making $300,000 a month. So obviously I had to stop it immediately, because that's exactly the kind of structure that gets flagged from audits. Now, what about the VAT? This is where many business owners make costly mistakes. In the UAE, the standard VAT rate is 5%. But, and this is huge, if your clients are outside the UAE, you don't charge VAT at all. So I can tell you how many times I've seen businesses needlessly charging 5% to their international clients, making their service way more expensive for no reason. One digital marketer from Italy had been doing this for 6 months before we sorted him out. And that simple fix immediately made him 5% more competitive. And yes, if you are paying 0% tax, you still need to register for taxes once you cross a certain threshold. Dubai isn't the Wild West anymore. It's a serious global business hub with rules and regulations. Which brings me to another huge mistake, and that's thinking you don't need proper accounting, because there's no tax. Even with zero tax, you still need clean books, proper invoices, and regular financial reports. Because in a few years, and trust me on this, Dubai will introduce stricter regulations and random audits. So if your books are a mess, you're in trouble. Now let's talk about the most critical part, making sure your home country can't come after you for taxes. Countries like the UK, Germany, France, Australia, and Canada, they are not stupid. They know people try to use Dubai as a tax haven. And that's why they use something called the Central 5 test. They don't just look at where you have visa, they look at actually where you really live, where you really work and spend your time. If your family still live in your home country, and I'm talking about your wife and your children, you still own a house there. If your business still effectively run from there, there are all red flags. I had a client from London who got a Dubai visa, flew out 4 times here for a week, each time, and he thought it was tax-free. 2 years later, tax authorities came after him for over £300,000 in back taxes. And why? Because his central flight was clearly to the UK. His family was there, his main home was there, and he spent over 300 days a year there. So if you think you can spend a few weeks in Dubai each year and magically become tax exempt, think again, it doesn't work that way. Let's talk real numbers. How many days do you need to spend in Dubai to make this work? For aggressive tax countries like the UK and Germany and France and Australia, for example, you need at least 183 days in Dubai. That's half a year. Anything less, and you're in the high-risk zone of being classified as a tax resident in your own country. For less aggressive countries, like some parts of Canada, for example, or some EU nations, 90 days in Dubai can work. But you need to combine this with strong ties to Dubai and weak ties to your home country. And it's not just about day counting, it's about proving your life is generally centered in Dubai. The UAE doesn't really track your days, but your home country, however, absolutely does. So what's a bulletproof strategy? How do you create a situation where your home country has no claim on your income? First, spend enough time here in the UAE, meaning 90 to 183 days a year, and that depends obviously on your home country rules. Second, cut ties with your home country, so sell your property or rent it out long term, close personal bank accounts, or do them to a minimal balance. Move your business operations to Dubai. Third, build substantially connections here in the UAE. So get a proper long-term apartment with a lease in your name. Open a bank account over here and use it. Create a social life or a business life over here. And the fourth thing is document everything. Keep flight records, boarding passes, say entry and exit stamps. Track your location data. Keep receipt for daily expenses in Dubai. And finally, get professional help. Do not try to DIY this because tax rules are complex and constantly change. What worked for your friend might not work for you. Let me walk you through the 3 biggest mistakes that I see costing people millions in unnecessary taxes. Mistake number 1 is taking a visa or thinking that a visa is a tax residence. As I've already emphasized, having a Dubai visa doesn't automatically make you tax-free. You need to actually live here and get a tax residency certificate. And without this, you're extremely vulnerable to tax claims from your home country. Mistake number 2, keeping strong ties with your home country. And this is a killer. If you still have a house or a family or business operations or spend significant time in your home country, you are asking for trouble. One German client kept, for example, his family apartment in Murch. Despite spending 200 days here in Dubai, German tax authorities still claimed him as a tax resident because he had a permanent home available to him in Germany. And these aren't isolated incidents. I see this happening every single month. Mistake number 3 is thinking Dubai is the Wild West. Dubai 2025 is not the same Dubai anymore as 10 years ago. It's a sophisticated financial center with increasingly strict regulations. So if you don't stay compliant, you will get caught. This means proper bookkeeping, regular tax filings, and even if you owe zero, maintaining all required licenses and permits. I have, for example, a client who ignored VAT registration requirements because he figured, why bother? I don't have to charge VAT to my foreign clients anyway. And the UAE authorities hit him with 40,000 dirhams in penalties for failing to register, and even though he wouldn't have owed any actual VAT. The days of showing up with a suitcase of cash and operating under the radar are long gone. Dubai wants legitimate businesses, not tax dodgers. So here's the bottom line for the UAE taxes of 2025. Corporate tax is 0% for businesses making under 3 million dirhams a year. 9% on profits above 375 for large businesses. Personal income tax is still 0, capital gains tax also 0, VAT 5% for the UAE transactions and 0% for exports. But to actually benefit from all this race, you need a proper business structure. You need a legitimate tax residence. You need to cut ties with your home country. You need to build a substance in Dubai. And you need all of that documented. Get these 5 things right and Dubai remains one of the best places on earth to build wealth without watching it disappear into taxes. Get them wrong and you could end up worse off than you ever left your own country. I'm also not going to promise that nothing will change forever here, because tax rules, they change constantly. But right now, for those who do it right, Dubai offers an unparalleled opportunity to legally minimize your tax burden. And the question is, what are you waiting for? Why keep losing half your income to taxes when there's a perfectly legal way of reducing them? If this video has been helpful, smash that like button and subscribe for more straight talk on global tax strategies. And if you want to know if Dubai is the right fit for you, drop a comment below or visit emifiles.com for a free tax consultation. For now, thank you for watching and I will see you in the next video. Or maybe Dubai.